So, good afternoon, everyone, and welcome to the first IAEE online conference. So, the topic of the concurrent session here is climate and investment. So I'll be both your technical assistant and your chairman for this session. This is a bit unexpected, so I'll try to do both. Don't hesitate if you have any technical issue to ask me. For simplicity, but I've seen you've already done that, please turn off your microphone if you're not speaking. And if you have any question at the end of the presentations, you can turn it on to ask your question. We will have 4 speakers. Bjarne Steffen, Nadia Ameli, Fagan, and Mathilde Tessier. So each of them will have 20 minutes for the presentation, and then they will have 10 minutes of Q&A. So you can ask any questions you want. I'll just don't be surprised if I interrupt you near the end of your presentation. I'll just remind you as the time approaches, so we stick to the schedule. And once again, don't forget to upload your presentations on the dashboard before leaving the session. All right, so first we start with Bjarne Steffen, who is presenting us a paper about the impact of electric utility ownership structures on low carbon investment decisions. So they're trying to study if the public ownership of utility structures fosters the investment in renewables, and the answer seems to be yes, from what I've read of your paper. So Bjarne, this is I'll let you speak. You have 20 minutes.
Great, thanks a lot for the introduction. Good afternoon, everybody. Good morning from Switzerland. I'm with ETH Zurich, the Swiss Federal Institute of Technology, and I'd like to present joint work with Valerie Karplus at CMU and Tobias Schmidt, also at ETH Zurich. We have a working paper out. If you're interested, you can ping me. And this is on the impact of ownership structures of utilities on their high carbon or low carbon investment decisions. I'll start with introduction, try to be very brief on hypothesis and data to then have most of the time for results, quantitative results, some qualitative results we also have, and then some points for the discussions that later on we can hopefully build on in the Q&A. The motivation for this research is twofold. On the one hand side, what motivates us is that we think that for the clean energy transition, this is not just about innovation of new technologies in the sense of inventing new technologies, but also about adopting technologies. Adopting new technologies large scale, like for instance, renewable energy in power generation. Secondly, we also think, okay, now I clicked too fast. I also think that we think that electric utilities are crucial for the low carbon transition. They make up a big share of power generation portfolios, despite all new entrants, IPPs, and so on. They are there to stay, likely, for a lot of reasons. So electric utilities matter, and it matters whether electric utilities adopt new technologies or not. A lot of studies have been published on certain policies that might incentivize utilities to adopt renewables or not. But what interestingly rarely has been studied is which role the ownership of utilities could play. With the utilities, at least in Europe, we have this interesting situation that we have both public utilities, so state-owned utilities, and private utilities coexisting, often in the same market for historical reason. And little is known how this ownership could affect whether they adopt new technologies or not. There's been a lot of literature, mainly in economics, on the efficiency of different ownership models, largely concluding that private ownership means more efficient operation. But this is mostly about thinking about utility in a given socio-technical system, and not so much about transitions, where it could matter whether you adopt new technologies or not, and where maybe the utilities could be locked in a certain technology pathways. So this literature doesn't really speak to some climate advocates or some stakeholders in the energy transition more generally, who question whether public utilities could maybe be more advantageous for having a transition to low carbon technologies. That's something that featured, for instance, in the US primary elections on the Democratic side. In the last UK elections, we have discussions like that in Germany. The question remains, what does public ownership versus private ownership means for the adoption of renewable energy technologies? Resorting to theory, there's a couple of things we could conclude from economic ownership literature and from innovation literature. So first, there's some reason to believe that managers in private companies, they go for more innovative investment decisions. Also because if there's an upside, they can profit more as compared to public managers. So translated to our situation, that would mean, like this first hypothesis, that if you have generally commercially viable renewable energy projects, private utilities would more often decide to invest in renewables compared to state-owned utilities. However, it could also be the case that if you have a government that generally pushes towards a low carbon transition, it pushes towards increasing the share of renewables, then it's the managers and state-owned utilities who more often decide to invest in renewables. So the opposite hypothesis, because these investors, they might share the worldview with the public owners and some other reasons. So this would actually be this hypothesis 2, the opposite of hypothesis 1. We would see state-owned companies investing more often in renewables. And if that were the case, then we would also see number 3, that a higher propensity to invest in renewables of state-owned, these are the private utilities, this would be more pronounced than in countries which actually have a more stringent climate policy in general. So that's our third hypothesis. And finally, one can think about how does all of this depend on the regulatory environment that we're acting in. And there's economic literature arguing that state ownership is typically used as a substitute for weak regulatory enforcement. In an environment where it's difficult to enforce regulation, then you have to resort to state ownership instead to get your way as a policymaker. So this would mean that this greater propensity of state-owned utilities is more pronounced if you have a weak enforcement environment. This is the more economic argument. And again, on the other hand side, there's a counter argument, which is brought forward mostly by political scientists, which is about state capture. And the question is, if you have state-owned companies, to what extent can actually these state owners then get their way with the policymakers that should control them? And if that were the case, that this is the dominant mechanism, then you would see that this greater propensity to invest in renewables of state-owned companies is actually less pronounced if you have a weak enforcement environment. So this is some hypotheses from theory that we tried to evaluate. We do that empirically with data for Europe. And why Europe? In Europe, we have the situation, especially in the European Union, that state-owned and private utilities, they play under the same rules. They are often even competing in the countries, and they're subject to the same regulation there. All EU countries have binding targets to increase the share of renewables. So there's, for all countries, this story applies that generally the government aims to increase the share of renewables. But nevertheless, there's quite some variance in climate policy stringency and regulatory quality that we can exploit. We look at utilities, incumbent utilities, 202 in Europe, 57 of them private. This is based on data from Platts and combined with Orbis data for company information. And these companies over the period 2005 to 2016 added some 75 gigawatts of capacity. So much about hypothesis and the data. Let's come to the results. First, some descriptives on the country level. So this chart shows the share of non-hydro renewables in total investment of utilities in the given countries. In total, we see that for the state-owned utilities, they dedicated about 33% of all investments in power generation to non-hydro renewables, as compared to just 11% at the private utilities. We look on the country level, there's 14 countries that saw both public and private utilities investing in power generation. And from these 14, I think it's 11 where we see this pattern with the public ones, the state-owned ones, investing more in renewables as compared to the private utilities, including like all major countries, the United Kingdom, France, Germany, and Sweden, like Poland, like all the larger countries, with the only exception really being Italy. So just at this phase, this very descriptive phase, it looks like the first hypothesis that that state-owned invest more in renewables could hold true. If we look over time, and here I just want to show the aggregate, we also have these charts for countries, obviously. How is that driven over time? This effect that the state-owned ones have a higher share of investments dedicated to renewables. We see that this really happened from about 2009 on, whereas before the companies, they acted more or less alike. Since then, it really, the share really increased strongly and decreased a little bit, but increased strongly at the state-owned utilities. So from about 2009 on, it seems to be that the state-owned utilities move at a much higher pace to renewables. So much about the country level, just the descriptives. Now I'd like to go to the utility level, where it's hard to show descriptives, but we have regression results. So here we take each utility as an observation, and we wonder what affects the share of non-hydro renewables in investment of this utility. And we do that both for the entire period that we're interested in. So this is column 1 and 5 here, 2005 and 2016. And then also break it up a bit as a robustness check and to see patterns over time in three subperiods. And first, what we show here is that the state-owned utilities, even when including controls on a country level, they show a higher propensity to invest in non-hydro renewables. If we add country level controls like the CO2 intensity of power generation, the GDP per capita, we see that effect, and we see it at the 10% level still with country fixed effects. So where we actually just use the variation within utilities in a given country in a given time period. Next, this is some results concerning to which extent the climate policy stringency in a country matters. I don't want to talk to all these tables in detail, but highlight some insights we take from that. So first we see that if we add some measure for climate policy density to the explanatory variables, we see that the effect of state ownership remains more or less at the magnitude as before, and the climate policy stringency effect adds to the state ownership effect. So additive in a sense. And if we use interaction terms, the significance levels, they drop. That's on the right-hand side now, also because we, simply because we have a number more explanatory variables. But you can see a tendency over time that like from these 3 time periods that we show here, it was earlier on that climate policy alone seemed to have a large effect. So the climate policy stringency mattered for the adoption of renewables, and then later on this moved a bit to the interaction term. So that really was the combination of having a stringent climate policy, and then you saw particularly the state-owned companies react. We did these analysis also for different cuts for shorter periods, for larger periods, and so on. It remains more or less robust at this significance level that I show here. So sometimes stronger, sometimes less. But I just present this cut into 3 slices here for time reasons. Finally, on the quantitative side, about the regulatory quality, we generally see that regulatory quality has a positive effect on investment in non-renewable renewables. And the more interesting question, if we interact different measures for regulatory quality that we employed here, it is not the case that the weak enforcement environment amplifies the positive effect of state ownership on renewables. So this story that that this is actually the only thing that policy makers can resort to using state ownership because they can't enforce other regulation. This doesn't seem to be at play here in the EU context, but rather the opposite, that there's at least some evidence that shows that when the quality of regulation is high and when corruption is low, then does state ownership lead to more renewable energy investment. So this state capture argument being played. So much about the quantitative results. As you notice, with this variation that you have across 200 utilities in 27 countries, you only can see so much, and it's all observational, obviously. So to better understand the mechanisms behind, we added a qualitative analysis, a case study analysis. And this is an analysis of the 10 utilities that saw the largest shift from non-renewable to renewable energy. So remember this chart over time that I showed. So in the earlier period, there wasn't really a difference between public and private utilities, but then from about 2009 on, they drifted apart. And so here we are interested in those utilities that saw a big shift. Why do we look at utilities that shifted their investment behavior? Because this shift typically was explained by those utilities. So we look at the 10 utilities that saw the highest change, and then analyze the annual reports of these companies, press reports, interviews, basically every statement that any board member made. There's a lot of local newspapers, for instance, in Europe that we could analyze to try to understand what is the reason for the shift in investment behaviors, this dash to renewables of those utilities. Those 10 case study utilities, they are all state-owned. So the largest shift, 10 largest shift, that's all state-owned utilities, which is in line with what we saw before. And then when it comes, yeah,
you have 5 minutes left.
Yeah. Then when it comes to the reasons and mechanisms at play, there's 2 of these utilities. That's the Swedish ones, Galatea-Kräfte and Rheinenergie in Germany, which had mainly commercial or profit-related reasons, whereas the other 8 utilities had mainly reasons related to policy preferences, why they shifted to renewable energy. So shifting policy priorities of the state owners played a role there, mainly climate policy targets, but in few cases also others, like with the CEST Energia, where it was reduction of local pollution that became a policy priority. With CEST, it was also reducing dependency on fuel imports. So shifting policy priority that played a role for 8 out of these 10 cases. Different mechanisms at play, partly direct fiat, so decisions by parliaments or governments. For instance, there was decisions for Minova, ENBW, and EDA in Portugal, where Parliament decided on ambitious renewable energy investment strategy for these companies. There was decisions to forbid coal investment in power generation for ENBW and for SWM, for instance. And there were some other decisions that made these companies go more to renewables. We also saw examples where the government chose managers, supervisory board managers, active board managers, and we saw a specific capital increase of the state companies dedicated at increasing the share of investment that goes to renewables. So these qualitative results, they add to the regressions. In sum, we conclude that in the EU, in the context we study, we see that state-owned utilities have a higher share of investment in renewables, and particularly in countries with stringent climate policies, where the general quality of regulation is high. We think that has some implications for the renewable energy transition. It means that state ownership can help to accelerate the adoption of renewables, apparently, but not because that would be an effect of state ownership per se. So just because state-owned utilities invest differently due to their ownership structure, but if there's dedicated government action. So if the government owns the utility and has dedicated policy priorities to influence their utility in a way. So there's in the EU, there's some example where using the state-owned utilities is explicitly considered as part of the policy mix. Two remarks. First, from a transition point of view, it could be the case that the temporal structure that we saw here matters. So in the earlier period, we didn't really see state-owned utilities investing more in renewables, even a bit the opposite. So it could be that in earlier phases of transition, it's really the private new entrants like independent power producers that are relevant for market openings. And then later, when it comes to upscaling, then the incumbents are more relevant. And second remark, just as a word of caution, with all these results, it should be kept in mind that here we consider only the impact of ownership on renewable energy investment, not on other outcomes, such, for instance, commercial performance. So any advantage of state ownership in renewable energy adoption has to be weighted against disadvantages in productivity, for instance. So I don't want to make an argument for nationalization or for more state ownership, but rather that for situation where state ownership anyway exists, then policymakers can think about exploiting it for climate policy targets. With that, thank you for your attention and happy to answer any questions.
Thank you very much, Bjarne. It was really interesting. All right, so now we have 10 minutes for Q&A. So if you have any question, please either write it in the discussion or ask it directly. And if you have several of you, I'll just try to organize everyone. Thanks.
I see Nadia. I think that's a hand.
Yes, hi. Thanks a lot, Bjarne. It was indeed very, very interesting presentation. I guess I have more some curiosity in terms of what kind of variables or proxy you use to capture those aspects. I guess you mentioned the policy stringency, so it sounds like there is the policy stringency indicator, but I don't know if you have used something else. And also was interested in how you estimate the quality regulatory in the countries. So if you just can provide a little bit more detail on the proxy of the variable used in the analysis.
Yeah, thanks. That's a good question because I didn't talk about it. It matters, obviously. So we used a couple of measures. So for climate policy stringency, the one that I showed in this presentation, I think that's an index on climate and policy stringency from German Watch, where they do a survey each year in, I think, 40 or so countries, including all European countries, to assess the stringency of climate policies, national climate policies on various scales. So it's a qualitative survey-based measure. We also used climate policy density, so just counting the number of climate policy, which is an established measure in political science, even though it sounds a bit crude. We considered using the OECD environmental policy stringency. That didn't really work because we couldn't calculate it for all countries. And then we also tried, but that didn't lead to any different results. There's from Yale University. There's also an index which is on environmental policy, not on climate policy. But those two could be related, so we also used that one. And for the regulatory quality, we used many World Bank indicators on several of them. Yeah, one on corruption control, one on regulatory, like on separation between public and between the government and business. I think that's the two I showed here. Yeah. An alternative we considered there is survey data from the World Economic Forum, which also exists. So that's what we considered.
Thanks a lot. Maybe can I add just a follow-up question? I'm just curious about the methodology, whether there was something also that you included in the analysis in terms of transition strategies that those utilities or incumbent may have in terms of restructuring really the business and the strategy just to comply to the climate targets, the policy framework.
Yeah, that's a good question. We have some information on that for this case study utilities. So for the 10s that saw this big dash, but we didn't really analyze it yet. Yeah, so so far we really looked at why did they do this, and we didn't look so much in which way did they do it to arrive at these higher share of renewables. Which where you see very different approaches, right? You see some of them, especially the bigger ones, who like build a separate renewable energy unit then besides the existing business. You see others who say, no, we want to like mainstream that. At the more local utilities, like we talked about the Stadtwerke, because before the beginning of the section, which like in the German-speaking countries, Germany, Austria, Switzerland, you have this local utilities. For them, it typically means that they make a joint venture of a couple of those local utilities and then jointly build like a wind farm or so. But we didn't really analyze that yet in the context of this paper. This is maybe something we could add here.
I have a question. Oh, just okay. Yanks, you first.
Yeah. So thanks for the presentation. It was really interesting. And I'm wondering, have you considered the cross-country investment? So like if a French state-owned firm invested in Germany, let's see. So yeah, I think that's the first question.
Yes, so we have those in our data. There's not super many of those utilities who did that, but there's some like many between the French and the Germans. these two directions. We have them, and they are categorized then as state-owned utilities, and the policy in their home country is that what matters then, because that's the channel that we think, right? So like another example is Vattenfall, which is a Swedish utility owned by the Swedish government, and then active across Europe, and then so the Swedish government moved towards like a strong renewable energy target, and so even for their investments, let's say in Germany or in the Netherlands, we then think, okay, is that affected by the Swedish policy priorities? So that's the way how we included those utilities.
Yeah. Thanks. So I think the reason I'm asking this is like because if a French state-owned firm's investment in France, it's more. I think it applies to the theory that that links to state-owned firm in France, but when it is invested in Germany, I'm wondering, like, maybe there is some change on their investment patterns. So yeah, I think it's just this point. I'm curious to know if you have thought about this.
Yeah, it's an interesting point. One could argue, for instance, that this link between the policy priorities and then whether the state-owned companies act accordingly or not, that this is stronger if both is in the same country, right? So you feel then that you have to respond to the policy priorities of the government in your country, whereas maybe the international subsidiaries, they don't care so much, yeah? And this link is weaker, one could argue. This interesting thing, I think with our data, we cannot study that quantitatively because there's just too few such cases, and each of these cases is a special case in a sense. But maybe in a qualitative study, one could look at this. Yeah. Thanks.
Thanks.
I just wanted to ask you about the links between the smart grids and the Stadtwerken. Is there, do they help fostering the development of smart grids? And as they are public, people may be more keen in sharing their information about consumption and things like that. Is it something you observe or not for the moment?
Yeah, it's not at the focus of this study, obviously, because here we talk about power generation investment. But it matters, and I think it's one of the reasons why we believe that utilities are there to stay, and that why in this whole transition debate, it's not just about you having new entrants and new companies emerging who then build renewables, but you also have to keep in mind how to transform the incumbent utilities. Because, like I said, I see a couple of reasons why I think utilities are there to stay, and one of them is their deep competence in the grid operation. And the increasing integration you also have of grid operation and then of like small scale generation and storage in some extent when it comes to digital technologies and smart grid developments, where this like these worlds of like the grid operation and then like the more generation and storage, which was totally pulled apart, suddenly grows together again, and that's what utilities do. So that's I think why the role of utilities might, like in some countries at least, where it was declining, might increase again in the next phase of the energy transition, which is more characterized by the integration of increasing share of renewables, of new demands like EV charging and heat pumps and so on, and then using digital technologies to facilitate this integration.
All right, thank you. We have room for one last short question, if someone wants.
Well, let's move on to
okay, let's move on
Nadia.
to yeah.
Okay, should I start share my screen? Okay. Let me go full screen.
Right.
Okay. Okay, perfect.
Right, so you also have 20 minutes, so I'll just give you a shout reminder when you have 5 minutes left.
Okay, thanks a lot, Pierre, and thanks everyone for attending this session. This is really a joint work with two colleagues at UCL Institute for Sustainable Resources, Sumit Kothari, who is a PhD student, and Michael Grubb, who is a professor in climate policy. And in this analysis, what we want to do is really to try to analyze one of the most popular policy tools that is now in the climate finance debate, and those are the disclosure initiatives, and where they really are able to shift capital towards low carbon assets. Okay, so in this slide, I really try to show basically how basically the attention has been increasing along the disclosure initiatives. A key date, a milestone date has been in 2015 with the Mark Carney speech on the climate risk for the financial system. And after the speech, it was really established the task force on climate-related disclosure in 2017-18. And I have to say that since then, improving transparency along the financial system is really one of the primary goals on the policy effort, but also industry, and also from the investor perspective. And really, we've seen quite a few initiatives at the global level, if we think about also the network of central banks and supervisor for green the financial system, or the European taxonomy, but also quite a few initiatives at national level. I think one of the most advanced one was the French law just in 2015, but also we had the Chinese guidelines for greening the financial system. And then I think more recently, the Bank of England efforts around climate stress testing. Again, I'm sure here there are many other initiatives ongoing, and the goal of this slide is really mainly to show how the interest in the policy has been really increasing and growing towards the disclosure initiatives. And the main, I think, assumption behind this, behind the disclosure initiative is really two assumptions. The first one is when we we make more transparency around the climate risk that our portfolio are carrying, then investors will move away from those carbon-intensive assets to reduce climate risk, and thus they will redirect capital towards low-carbon opportunities. So whether it's made explicitly or not, the idea behind transparency is really rooted in the efficient market hypothesis. So if you give enough time to markets to provide the relevant information, the market participants will really respond rationally to information and will change their behavior. So in this analysis, we really analyze 3 dimensions. The first 2 are 2 dimensions of the disclosure initiative. The first one is whether the belief that divestment is driven by disclosure. The second point, it's more about this investment switch from high to low carbon assets. And finally, we really offer some thoughts on where we think also the policy should focus. It could be interesting research area for the future. But let's start from the first point about the divestment and disclosure. I think there is one trend, which is the financial trends, the financial returns in the fossil fuel sector that somehow has been a little bit overlooked in the debate. In the last 10 years, if we see really the data, and I'm showing now the picture for United States, but then for Europe, the fossil fuel industry have really shown declining financial returns. And to make the case here, we took one index, the S&P 500 index, and you see the blue line is the general index, while the red line, it's only the part of the index that captures the energy companies, are the main energy companies in the US, like ExxonMobil, Chevron, and other players there. And you can clearly see how basically big is the difference between those 2 lines. And what is really striking is that the fossil fuel sector has really underperformed compared to the overall market. And the overall market was more than double profitable compared to the fossil fuel. We do have a very similar pictures and trends in Europe. Here we took a different index just to get the picture for Europe is the Morgan Stanley index. And we see exactly the same trend. It's the red line, which is the energy companies. And because it's here European level, we do have the main energy players in Europe like Total, Royal Dutch, Equinor, Eni for Italy. And you see all those companies have underperformed again the overall market. The trend, the difference is slightly less, but just because the red line is the same as the blue line that in the US, as you can see, it's much more steeper. And that's because the best company or the most performant company on the market now are the IT giants like Facebook, Apple, Microsoft, Google, and they're all based in the US rather than in Europe. But still, I think it's quite clear the difference between the overall market and the fossil fuel industry. And we need to keep in mind this also in terms of what are the historical trends regarding the oil sector. And that's really just the picture of the oil prices over the last few decades. And you can see that it's been quite volatile. There are quite a few occasions where we see those spikes. And also we see that the oil price dropped by more than 30% in quite a few occasions. And what we really need to remind us is that usually the oil industry has been quite a high volatile industry, but also a very high return sector. I think that that's been really the story of the last 50 years until the last 10. And there has been quite a few factors on the supply and the demand side that really determine the sector volatility. And on the supply side, definitely the OPEC influence, the US shale production, and also the demand side, all the global crises like the Iran-Iraq war, the financial crisis, more recently the pandemic, all those factors that really had an impact on the sector volatility. But what also was happening in the sector was that there were really oil super cycles that somehow really enabled the oil prices to vastly exceed the production cost. And this all resulted in very high returns for investors. I think the picture has been changing in the last 10 years, and we've seen that literally there are some interesting dynamics in the last 10 years where the fossil fuel sector really had lower financial returns, underperformed the overall market. And the outlook in the short term, in the long term, it's quite uncertain. So the sector was already experiencing some interesting dynamics, and I think the share production was one of the playing a big role. In this context, climate change really adds an extra layer of uncertainty that can further increase the sector volatility and reduce its return. But already the sector was in a sort of complicated dynamics. And again, in this, if we take this picture, I would believe that most investors hoping for really all high returns will monitor a little bit more the OPEC-Russia relationships, the OPEC decision on quota, production quota, rather than really the results on carbon transparency. If we move to the second assumption, which I think it's even the stronger one that has been made in the disclosure debate, is about this really transfer might, we call it here, from high to low carbon investments. So if we think about the assumption, basically we are treating high carbon and low carbon assets as very similar assets, actually perfect substitutes. So they all became, all those assets are part of the energy baskets. So as long as one asset, the high carbon, became riskier, so money will just flow to the safer one, which is the renewable assets. However, what we claim in this analysis is actually that those assets are not really similar, but they are quite diverse. And we start to make this point by analyzing the market structure. If we see the fossil fuel structure, historically has always been dominated by really few players. So in the 70s, we see in the Seven Sisters, so this group of 7 companies that were really regulating and matching the demand and supply at the global level. Then after the 70s, we saw the emergence of the OPEC association and the OPEC member countries. And really all those countries, they own most of the reserves at the global level, and also they dominate the production, the oil production. And then after this, we also saw the emergence of the state-owned companies. And here I just mentioned a few of them, the biggest one. But also we need to keep in mind that those are really big players. If we just take the case, for instance, of Saudi Aramco, last year, Saudi Aramco will reach the 1 trillion market capitalization on the market. This is an incredible result. I mean, when, again, 1 year ago, so Apple made this 1 trillion target, we can count the number of companies with such a market value. So what this means for the sector is we really can see a very consolidated structure that translated in a cost reduction along the value chain, but also in asset acquisition to support a very fast growth. And because those players are really big, they don't have a strong negotiation power in contract relationships. All these 3 factors really translate in high returns on capital invested and value for stakeholders. And I guess also they could count on a financial ecosystem that was supporting the whole process and the growth. So the financial ecosystem for fossil fuel was really used to dealing in huge scales through major institutions. When we look at the structure of renewables, we really see a totally different picture. Renewables only start to emerge at the beginning of 2000. We saw actually few players, and here the most known company in the solar and the wind domain. But still, if we look at the structure of the industry, it's very fragmented. And today is still a very young industry with a less integrated supply chain, with so many players that are specialized in just one technology, can be solar, can be wind, and also sometimes operating on a single geographical market. So if we can borrow one basically expression from the fossil fuel, we can say that the renewable domain is still missing its measures. It's also worth mentioning that there are actually few companies that they manage to leverage economy of scales. So the economies of scales, so like Enel or Iberdrola, those are kind of really few companies that somehow were able to expand their portfolio technologies and were able to operate across markets. But still, most of the players are kind of mid-sized companies, as I said, quite basically specialized in one technology and one single market. Additionally, there is another aspect that we need to take into account. Renewables are much more sensitive to local conditions. They are not an international traded commodity like the oil, which is traded in USD. So there is a currency risk for investors. And also, still, most renewables rely on the energy policy framework, and it's quite well documented in the literature that regulatory risks are the most important risk or the most relevant risk to investors. And that's really the result. And if we look at the market today, that's really how the players in both industries look like. Here we combine a few data from Bloomberg that basically capture the market capitalization. For those who are not familiar with market capitalization, the market capitalization is simply the value of the company on the market. So it's really the number of stocks multiplied for the price. And also we combine the revenues and then we rank those variables. So the red bubbles are the fossil fuel, the top 15 fossil fuel companies, while the green one are the top 15 renewables. You can immediately see the huge difference between two players. And we're really talking about a different order of magnitude, because if we take, for instance, the case on ExxonMobil has a market cap of 330 billion, while Ørsted, which is the first renewable player, it's about 70. So it's really quite a different scale of basically sites. So the lowest, again, the lowest fossil fuel company equals the top renewables. And if we take the last ranked renewable companies, like the last 3 or 4, they do have a market cap that is 10 times smaller than the lowest fossil fuel companies. This is quite important because market cap is really positively associated with investments. So we do have quite some empirical evidence showing that the bigger you are, the more you're likely to attract investments and investors. And this really leads us on what are the implications on investment. So fossil fuel assets are really and have been the main targets of mainstream investors. And for mainstream investors, I really mean institutional funds, so pension funds or insurance companies, asset owners, asset managers. And looking at the data, really the financial sector is highly exposed to fossil fuel and climate policy relevant sector. This exposure has been measured about 45% of the portfolio. And again, we have to see that historically, it's always been in this way. So in the 80s, if you as investor would invest in fossil fuel, you would get really returns around 30%. And that's why really the financial sector is highly exposed towards those assets. This is unfortunately not the case for renewable assets, which basically are still struggling in attracting key investors. And here I try to list some of the 3, I think, key factors or some of the 3 important factors that why renewables are not really meeting investor criteria. The first one is the low liquidity. So low liquidity, the liquidity of an asset is measured basically if you can really go to the market, sell the assets, and you don't incur in any price loss. So that means if you want to sell the assets, there is someone on the other side who is ready to buy it. And it is captured through the daily traded volumes and outstanding shares that you're able to buy and sell. And it's very low when it comes to renewable. Then there is also a very limited number of companies that investors can pick or can invest in. Especially the big investors, they do have a threshold in mind when they screen for companies.
You have 5 minutes left.
Oh, thanks a lot. Yeah. It's this market cap is around 200 million. And that's because the due diligence process is quite long, so it requires quite resources. So you really want to go towards company that make it basically pay off. And when you apply this threshold to renewables, it's very bounded your choice. I mean, you have 10, 50 companies, Europe, 10 in the United States. So you really cannot pick many of those companies. And on top of this, renewables, they do have a very short trading history. They start to emerge at the beginning of the 2000s. They start to go on the market towards the end of the 2000s, and they're still treated as a very developing asset class. Again, for fossil fuel, it's really the other way around because investors really used to the dynamics of the sector. They know the sector very well. They know how to deal with the volatility. So the main conclusion is really that these assets are quite different, and there is not this energy investment system where capital just moves easily from one technology towards the other. So capital, even if you as an investor feel that your portfolio is very risky because you're really exposed to fossil fuel, You can decide to divest, but capital could simply exit the energy sector and go to other sectors like IT or pharmaceuticals, because those are at the moment the sectors that are most performing on the market. So what we suggest is that disclosure is important, but there are at least three other areas where we think are quite important to take into account in policy design or as a research. First of all, is the boundaries of the financial system. We really need to target specific investor groups. We need to understand the preferences, investor drivers. We need to make sure also that the renewable players will grow. We don't know actually if the growth of the renewable sector will be led by few players, and whether we can have some renewable measures, or we still rely on those mid-sized companies across the world. We also will need to integrate a little bit more financial elements into policy design, again, to capture all these synergies, and also to try to take a transition perspective, and I'm glad that also Bjorn mentioned before, and how this transition can be triggered by financial elements. And finally, I do believe that a big challenge will be in developing countries. Those are the areas of the world where most investments are needed, but also where it's much more difficult to mobilize capital flows, because they are very risky contexts, and there is not, financial markets are not well developed there, and it's much more higher the cost of capital. So we do need to create some financing channels that are able to manage those investment risks. There is somehow, it's missing a strong narrative behind public support, that there is a risk of a climate investment trap, and we talk a little bit more of this basically concept in a different analysis. That's really my final slides. We believe that disclosure seems an insufficient response to the carbon transition. What it really does is it protects the financial system from climate risks, rather than really redirecting financial flows towards low carbon assets. The disclosure narratives also, there is a little bit of risk that exempts the financial system from radical action and long-term systemic change. So we do really need to do something more in terms of policy signals, but even more important, to redesign a financial system which really has some preferential mechanisms towards low carbon assets. There are some ideas also in terms of scaling up some specific financial channels like green bonds and exchange traded funds. But really, I think what it's a little bit missing is how we can really create those preferential mechanisms for the financial system to directly invest in low carbon assets. And I think, yeah, that's it. Sorry, that's some supplementary information, but the presentation, yeah, it's done now.
Thank you very much for this very clear and interesting presentation. So once again, we have 10 minutes. So Bjarne, I see you're raising the hand, so you have the first question, please.
This was applauding. This wasn't raising my hand, but thanks for the great presentation. But I actually do have a question, or maybe a remark, and would be interested to hear your view on that. I think it's super relevant what we raise here. We also work on disclosures and on thinking about how to make them useful for redirecting capital flows, because I agree that they don't really come from redirecting capital flows, but they come from taking out risk of the financial system, right? So that's how the TCFD started and so on. But then thinking about, okay, how could they help us to redirect capital flows? I wonder whether this analysis is maybe a bit pessimistic, in the sense that you very clearly show that this probably won't work to redirect finance from fossil fuel companies to renewables. But I would say that's also not necessarily what I would expect, because I mean, if I'm a climate conscious investor, I think I would know already that Chevron maybe isn't the best bet, and Vestas or Siemens Gamesa or whatever is green. So I don't know if I need so much more disclosures. But what we are looking at is more like the border cases. So let's say I want to invest in chemicals, or in food and beverages, or in manufactured products, or so industries where it's not so clear which one of these companies that I could invest in is actually more on a pathway in line with the Paris Agreement. And so I wonder whether they are in these more border cases, where it's not just about leaving like an industry at all and moving to another industry, as you're showing. Their disclosures could still help. Notwithstanding that for this transition that you're analyzing from the fossil fuel companies to the renewable energy companies, I fully agree we will need other policy instruments to make that happen fast enough.
Thanks a lot, Bjorn. And I maybe agree. I think there was quite an opinion. Also, this analysis, it will come as an opinion piece, and so it has quite some strong views on the field. But I do agree actually that disclosure is not negative %. I think we do need some, clear information of what can be green, what can be some climate-aligned investments. So I think it's great actually to do some steps towards this direction. Exactly for what you said, as a conscious investor, you really would like to know a little bit more, how a climate-aligned portfolio may look like, and that's really the taxonomy. It would help in this, the disclosure would help. I guess what we were trying to make here was more this, to think about low carbon and high carbon together and how they relate to each other. And I guess it has been a bit made in the policy debate, the association that disclosure, I mean, if you're a conscious investor, also will divest from those risky assets, it will move to the low carbon. I'm saying this also because I was reading a bit on other empirical analysis, trying to analyze the divestment movement and the divestment campaign, which actually have been quite popular again 15 years ago. But actually they didn't find an empirical evidence on fossil fuel finance. What they found was, okay, there is a public shift in the public discourse, there is more awareness, but actually it's quite insignificant, the real effects on portfolio allocation, the fossil fuel finance, which is actually what we really care about and what we wish to see. And I guess also because the renewables are somehow missing still those equity investors. There's quite a lot of project finance, but also those mainstream investors are not, I mean, it's not really the target of their assets, their portfolio, while it is the case for fossil fuels. So I guess we were trying to really to think about in a comprehensive way how we can combine both arguments and really the low carbon, the high carbon, think in terms of the transition. But I do agree that it's still quite useful, and it's great the first steps that we see in the disclosure policies or the disclosure efforts.
Right. I think Carré has a question.
Yes, thank you. My question was pertains to your list of companies that you compared, and revenue and market capitalization, and a little bit about companies that were not present. So companies like NextEra Energy in the US, who has a market cap of over 100 billion, and they own more energy infrastructure or renewables than any other company, I believe, in the United States. So I guess you discussed difficulties in categorizing companies and that there's maybe not an energy sector. So maybe it falls into that, but it seems that there are companies that invest in renewables, but maybe you're hard to classify, and they are of large scale, mostly electric utilities that invest in these kind of things. So I don't know, just your thoughts on companies that are in your list and not in your list, and then also if you could expand on what you meant by the climate investment trap.
No, thanks a lot. This was indeed actually one of the most controversial parts in our analysis, I have to say, even among our, the authors. The way we came out with this list was really through Bloomberg. So we ran a few queries. We took into account what Bloomberg classifies as of oil and gas companies and renewable players. Then we had additional players like power generation that Bloomberg, it's a little bit mixed in the picture because Bloomberg categorizes power generation company, all those working in the power sector. And you have renewables, but also fossil fuel companies. So what we did was try to understand where most of their activity or electricity production was. For instance, Ørsted, in our list, it's the top renewables, but you can also claim that it has a different track record. Or there are other companies that can be actually sit on both industries. So that's really the way we come out with this list, and it's only the top 15 for fossil fuel and the top 15 for renewables. We also apply a free float criterion. So there is a free float above 25%. So the free float again is the part of the stocks that you're not traded. For instance, in the picture, there is not Saudi Aramco, there is not any state-owned company, because those companies are not subject to divestment or investments from investors. Saudi Aramco, for instance, it would be definitely the top one, but only 2% of the basically capital is traded on the stock. So we thought it's not relevant to the divestment and investment dynamics. But I agree that we can definitely expand this list. And I guess it's still kind of controversial, especially those players that they start more in the traditional generation power, and now they try to transition towards renewables. They do have actually quite a relevant renewable production in their companies or in their branches. So I guess it's yeah, that's really what we try. We try to come out in the most objective way. So basically from Bloomberg queries, and then we made a little bit of personal judgment in saying, okay, where most of the electricity production comes from when it comes to this company. That was the final basic criteria that we apply in order to classify the company into the renewables or fossil fuel.
Perfect. We still have 2 minutes for one last question. Does any one of you has one? No.
My second question to her was to discuss what she meant by the climate investment trap.
Oh, sorry. Oh, yes, the climate investment trap. I missed the point. It's something that is forthcoming actually in another publication from my group. And what we conceptualize this idea of the climate investment trap in developing countries. So basically, those are areas where you really need high investment needs, and where also the cost of capital is very high, because those are risky contexts. So it's much more difficult to mobilize capital, and investors, in order to invest there, would require higher basically risk and premium. So it's an area where you have really this financing gap. There are no capitals, and the cost of capital is much higher. And the fact that you don't mobilize the investment needed also, that means that you don't intervene in terms of mitigation or adaptation. So again, the effects of climate change are even worse, which again, in a cycle, makes even riskier the context. And again, it rises further the cost of capital. And that's why we call this sort of climate investment trap, because there is a sort of cycle where you need investments, the context is riskier, and those is getting riskier every year because you don't intervene as you should be. If you're interested, there is really the forthcoming publication in Nature Communications. So we got the provisional acceptance. So hopefully it will be available to everyone in a few weeks from now. Thanks again.
Right. Thank you very much, Nadia. Now it's time for Marie for your presentation. So just tell me when you're ready.
Okay, thanks, Pierre. Let me share my screen.
Yes, sure.
Actually, let's see.
Hopefully it's still working.
Okay.
Yes,
can you see it?
It's working.
Okay.
Yes.
Right.
Perfect.
You see. Okay, thank you. So I'm very pleased to be presenting this. I'm Marie Fagan with London Economics, actually based in Boston. And it's great to be presenting for the IAEE. I'm VP of Business for the USAEE, or sort of sister organization. So thanks so much. And I'm going to be talking about liberalization, decarbonization, and nuclear recovery, sort of the triple treat for Japan's electric power sector and what it means for energy prices. And I think this actually fits in with what the two previous presenters were talking about, because they're talking about optimal policy directions. You know, how do you get investment to move into climate? Of course, that being our theme. And this sort of takes it the other way, where we're looking at the policies that are in place, in Japan, and what does that mean for investment decisions? The work was done for one of our clients who was considering investing in solar power in Japan, and this was part of their due diligence. So I think it fits in very well with the session. Let's see. What did I do wrong here? Oh, there we go. So just to outline what we're doing. So start with the introduction. We'll give you the bottom line in case you're busy. And then talk about the triple treat, the energy market liberalization that's going on in Japan, the energy and climate targets, and then the status of the nuclear fleet, which if you're familiar with Japan is a crucial part of their electricity sector. And we'll talk a little bit about our methodology and our outlook and our conclusions for prices. But as I promised to give away the stuff in the beginning here, we want to just start with the questions that we asked, which was what do Japan's 2030 energy and climate targets imply for their power generation mix? What needs to happen to get there? And what are the implications for energy prices? Because obviously energy prices are a very important aspect of due diligence for any investors in low carbon or any kind of power, really. So our methodology was pretty straightforward. We looked at market structure and liberalization. We had the starting point for energy prices. Then we examined the details of the Ministry of Economy, Trade and Industry's 5th Strategic Energy Plan for 2030 and beyond. We looked at the status of the nuclear fleet. And then methodologically, our economic assumption is that energy prices converge towards the levelized cost of a new power plant in the long run. We used METI's projections for the levelized cost of power. And then we developed scenarios because we're looking out 2030 and beyond. A lot of things can happen. We don't know the future, but we had to identify a key uncertainty that would push you into one future or another for your power prices. So what does that all look like? Just to sort of, again, give away the key takeaways. The energy and climate targets for Japan for 2030 are pretty modest, but they're still going to require faster recovery of the nuclear power fleet than seen in the past 10 years since the Fukushima disaster. So again, they're modest targets, they can be met, but they have to restart many more nuclear plants than they had in the past. Without the nuclear plants, their targets for reduced dependence on fossil fuel and reduced dependence on imports, which is very important in Japan, for lower oil, gas, and coal aren't going to be met. But it also tells us that Japan could help, boost its way to those targets by extending licenses for existing and operating nuclear plants as a partial solution. And what does this mean for midterm, long-term energy prices, looking to 2030 and beyond? They're going to be shaped by the levelized cost of new nuclear plants, and we'll see how that, is a result of policy, or perhaps new offshore wind, because that's another large-scale source of renewable power for Japan's policy, especially as they firm it up for after 2030. And our analysis does suggest that the path for long-term real prices, if you exclude transmission distribution, is about 10 yen a kilowatt hour on the low end, if all goes well on the nuclear side, but it could be up to 20 yen per kilowatt hour or even higher, depending on the cost of offshore wind and whether or not you want to include subsidies. So let's take a quick look at that first piece of our triple treat, which is energy market liberalization. It's been going on, there's been a process of market liberalization in Japan for a number of years, but their first must-offer energy markets went live in April 2020, about a year ago. You can see in this chart on the left that day-ahead volume, they have a day-ahead and an intraday market. Day-ahead volumes are trading up near 40% of energy consumption. So that's been increasing over time. People knew these markets were coming and they're getting in ahead of time practicing. And then you can see on the right, the average retail energy price, if you include, this is including transmission distribution, you've got the high end, the regulated tariff that initially they were going to get rid of in 2020, but it's still in place for low voltage customers, residential customers. And then you see energy prices around 19 yen kilowatt hour on average, declining a little bit after markets liberalized. If you exclude transmission distribution, you're about 13 or 14 cents a kilowatt hour. And that gives us a baseline to start looking at what'll happen going forward under the strategic energy plan. It's a starting point for our outlook. And they developed several other markets too, a balancing market and a baseload market, also important pieces of liberalization. But we'll take a look at another piece in more detail that went live in 2020, which is Japan held its first capacity market auction. And for those of you who cover electricity markets in detail, you know that a capacity auction helps provide revenue for fixed costs to make sure that plants are in place a few years hence. They might not earn all their costs on the energy market. So the way these are structured is usually the regulator decides, how much capacity is needed. In this case, they wanted 177 gigs. They decide on a referent price called a cone, a cost of new entry, and they will set offer prices, in this case, at 150% of net cone. Cone was based on the cost of a new LNG plant, and that's as much as you're allowed to offer. So with the cost of new entry, that was about 14,000 kW yen. The technology that was allowed to bid in this market was wide. All these eligibilities, the small chart we have on the right, LNG, coal, pumped storage oil, everything, including nuclear power, was allowed to bid. And the auction was structured as a single clearing price, which means that whatever the high price that you need to clear the auction, all the bidders get that price. So we looked at the results of this auction that was held late summer, early fall last year. Bids ranged from 0 yen per kilowatt. I'm going to be around, I'm going to produce, I'll take whatever price you have. But there were bids at the clearing price of 14,000 yen per kW. That's a pretty high price. It's the top you could bid. The price will end up being paid by retail energy providers by billing customers. And so not surprisingly, some of the retail providers have kind of complained to the regulators to please have a look at these rules. But even so, even though that was fairly high, the construction cost of a new nuclear plant is 20 times that. It's estimated by the ministry at 370,000 yen per kW. So really what this tells us is, even if you look at the generation that was offered into the auction, you've got a lot of fossil fuels there. But the capacity market, it's not a tool to achieve Japan's decarbonization targets. You've got plenty of fossil fuels clearing that auction. And clearly, it's not designed to attract nuclear power per se. Not that there aren't other things in place that might do so, but not the capacity market. But Japan does have other policies in place to encourage renewable power, particularly a feed-in tariff, which is widely used in countries in Europe, for example. It's been in place a while, but costs are falling for solar. In 2017, Japan began doing auctions for solar power, reducing price. And they had a new law passed last year, which will replace a fixed feed-in tariff with just a premium to energy prices, or competitive energy prices. That's going to apply starting from about a year from now for wind and large solar. So, what we can conclude here is that the feed-in tariff's not going away. So Japan's still going to provide incentives for renewables. Renewable developers can continue to expect a market premium. So restructuring the FIT, making it more sensitive to market forces, but it's not going away per se. So that brings us to Japan's energy and climate targets. And the ministry's targets, as I mentioned, for electric power, they're specific through 2030. They're more general through 2050. We've got a summary of them here. I won't go into it in detail, but just to understand, they're not mandatory, but they are developed in consultation with the industry. So we do expect the industry to do its best to achieve them. Japan also promised to cut carbon emissions by 26% below 2013 levels under the Paris Agreement. But remember that 2013 was after the Fukushima accident in 2011. So the 2013 levels represent a loss of renewable power and fairly high carbon emissions because of that. So it's kind of just low-hanging fruit. In 2021, though, the Prime Minister raised the greenhouse gas reduction target to 46%, which is actually a bigger stretch. That METI's next strategic energy plan, they do them every 3 years. They'll be updating it in 2021, and we do expect it to reflect more aggressive carbon reductions. But I did mention that their targets are quite specific through 2030, so let's have a look at what those actually look like. Again, not a dramatic change. So if we look here on the left, we have 2018, the mix of energy generation in Japan. We've got that small little green slice of nuclear generation. They haven't restarted, and they still haven't restarted many nuclear plants. 2030, you see a lot more nuclear, that green area, and then a shrinking of coal, which is orange, and we've got gas in purple. So Japan's looking to replace fossil fuels using nuclear, and it looks like a big increase from 2018, but if you compare to what was in place before the Fukushima accident, this target in 2030 of 234 billion kilowatt hours, it's lower than what Japan was producing in 2010, 288, before the Fukushima accident. So it's kind of like a back to the future. It's certainly an improvement from where things are now for climate change goals, but it's not, huge progress compared to 10 years ago. But it does require restarting many more nuclear plants than they have so far. So since this is very crucial, we looked at it in detail. So if you look at the purple, all this purple on this pie chart, basically only 11 gigs have restarted so far. That's like a third of the fleet that was shut down after the accident. And if you look at sort of government agencies statistics at a high level in Japan, they'll refer to this whole purple area in the pie chart, about half the pie chart. They classify them as in operation. But if you look at the fine print, 2/3 of them, only about 1/3 is restarted. 2/3, they're approved, but they're not started yet. They're under review, or they haven't even filed to restart. So what it means is if Japan's going to hit its 2030 targets, they've got to restart far more nuclear units in the next 9 years than they already did in the past 10 years. So it's not impossible, but they really have to accelerate the pace of what they've done in the past. So now let's briefly turn to our methodology for looking at what this policy and these directions imply for prices, which are of course key for investors. So a key input into our methodology is the ministry's assumption for the cost of various new power plants to 2030. So you can see down on the left, low cost, 10 yen per kilowatt hour levelized cost for nuclear. And that includes enhanced safety, post Fukushima. And on the right-hand side, or second to the right, we've got offshore wind at 20 yen per kilowatt hour plus a substantial subsidy. And this is the ministry's projections for 2030. So what you notice here as an economist who's supposed to be looking into what could happen in the future for your clients is that a variety of different things could happen. This is a very wide range of prices. So what does it depend on? Well, if the Japanese public accepts new nuclear power, if they can restart their nuclear plants, in an accelerated manner, and nuclear construction prices are what the ministry says it will be, then power could be quite inexpensive going forward. Your referent power plant that needs to be built to meet these targets is a nuclear plant at 10 yen a kilowatt hour. But if there's problem, if the public doesn't accept more nuclear power, if prices are higher to build them, and you really are trying to decarbonize for 2030 and beyond, offshore wind could be scaled up, but it's a lot more expensive. So we saw that as the key uncertainty that would give you either a low cost outlook or a high cost outlook. So just to give you an indicative range, again, turning on public acceptance and the cost of nuclear power, we have scenario 1 there in the red line with slightly lower power prices than in the past because of affordable nuclear power. But scenario 2, assuming that nuclear power doesn't go forward easily, and perhaps you need offshore wind, you might need subsidies, you might need a carbon tax to get those done, you could see much higher prices. And again, this is indicative, maybe they don't peak in 2034, but you're bringing in much higher marginal cost for the marginal power plant.
You have 5 minutes left, Mary.
Oh, thanks, Pierre. Okay. So when you step back and sort of take a squint at this, you can kind of see there's a lot more risk to the upside than to the downside for energy prices. That's not maybe a great thing for your customers, but if you're an investor and you're looking at, say, putting in solar, that's kind of positive. It looks like you've got some headroom, which is, I think, what our client concluded. So then for our last slide, to sum things up, then, the energy price depends on nuclear power's recovery, its acceptance by the public, and the cost to build plants. Japan can achieve its 2030 targets, but they really have to speed up restarting the nuclear fleet about twice as fast as they have been. But again, they could have the possibility of extending licenses for existing plants. The path for long-term prices we see is ranging from 10 yen a kilowatt hour on the low end to 20 plus on the high end. But then when you step back, you realize that this ongoing liberalization of the power industry, it doesn't seem like it's either going to help or hurt Japan's ultimate climate targets or their long-term costs. So that is the presentation. Happy to take questions.
Thank you very much, Marie. All right, I'll start with a short question. We've seen that there's very few solar capacities in the charts that you've shown. I was wondering, because the south of Japan enjoys a very high solar irradiation, is it because the distance is far between the south and the main consumption centers in the main islands that you don't have so much solar investments?
Oh, that's a good question. I don't know the precise answer, but when you think about Japan's power grid for many years, first of all, it's two separate grids. When Japan had reconstruction and was rebuilt after the Second World War, they have two separate power grids on different voltages. So it's not, you can't think of the country as an integrated grid. They operate separately. One of the goals of the regulator under the new system is to try to get the island more integrated. There's sort of 10 separate utilities. They've all been, operating in their own system. Octo now is going to be the grid operator. So that should help. As you say, this is more, it's not these sort of centralized nuclear plants and centralized LNG plants that are at key positions on the shore, at ports. There's going to be a lot more integration of the system. And I think that should help quite a bit.
Thanks. Who has questions? All right, I'll continue with the second question, if you don't mind.
Oh, yes, absolutely.
Oh, who had a question? Oh, sorry, I thought someone had. Just don't hesitate to raise your hand if you have a question. You've shown that there are currently some nuclear plants being built. Is it? So I just wondered, when was the decision taken to build these new plants, and is it a plan to replace some plants that are supposed to be decommissioned? When exactly were those decisions taken?
So some of those plants have already been permitted. I wonder if I can go back. Let's see. Right, so quite a few plants have already been permitted and some are under construction. We did a forward look, of the whole fleet over time, not too many slides to include in this, but we looked at sort of the existing plants and retired those when their lifetimes should retire, 40 years, but of course now that you can possibly extend them 20 years. But if you build all these which are under construction, on all these which are permitted, and then restart all these other ones in purple, you just meet targets for 2030, just rolling this fleet going forward, if you allow some of the existing ones to retire. So if they want more nuclear power and less emissions after 2030, we've got some permitted and some under construction, they have to build still a lot more. So that's why we're talking about needing, public acceptance. So you can just reach 2030, but they're going to be addressing goals to 2050 and beyond. So some of these have been permitted. This has been, in the past decade or so, some are under construction. There's beyond what we have here in this pie chart. There still needs to be more after 2030.
Okay, thank you. Oh, all right. If no one has a question, maybe we can now to the last presentation. So as you said, social acceptance is a key element in the energy transition, and this makes a nice transition to the last presentation. So Mathilde, just, yeah, if it's working properly, you can start anytime you want. Thank you again, Mary. Okay.
Hello, everyone. It takes a bit some time to load the presentation, I guess. So my name is Mathilde Tessier, and I'm working in the Center of Applied Mathematics of Mines, which is actually in south of France. And I will talk about with you about long-term assessment integrating social acceptance. So energy modeling is now the goal of energy modeling is to offer mitigation and adaptation solutions to the climate crisis. And even if the long-term scenarios we design are wrong, because every models are, the energy modeling community is always looking to design realistic scenarios. And actually, there is one thing that can be lacking is the lack of integration of the question of social acceptance. We saw in the last presentation how crucial it was and how crucial it could change. And the idea of this work is to find methods to include these questions into energy modeling. So I will briefly speak about what is social acceptance, what is the vocabulary, the concept, and then we'll go to energy modeling. I present the model I use and the first scenarios I could realize, and then maybe we'll deep a bit diver into the search for indicators, and I will discuss about it. So the concept at stake, so when I speak generally about social acceptance, but actually it represents a lot of different words. So there is this term of acceptance, which is normally an a posteriori evaluation of the project, and I use this term always for also the other terms. So there is acceptability, which is a priori evaluation of a project. So basically before it is implemented. And then you have these two notions of support and opposition that are active engagement. So the people you can see on the streets or that will sign online petition or things like that. And then there is this last term, which is maybe the most known when we speak about social acceptance, which is NIMBY, for not in my backyard, and it is often defined as an opposition between a general positive opinion, for example, on renewable energies, and a local opposition, for example, to a specific project of windmills or solar panels. And actually, though this term is really often used in the daily life, it is very controversial in the literature because, like, most of the time we see the people that oppose the local project as egoistic, and actually there is more to it. And the other main important point is that when we think about social acceptance, most of the time we think about public acceptance and acceptance by the citizens, so the people that live near the project. But the other important thing, people, stakeholders into this acceptance are also the industrials, so the companies that are locally or nationally involved in the design of the realization of energy projects. And then the other important stakeholders are the decision makers. So either the local or national politicians who have an impact on the siting decisions of the project, or the public investments, or the design of the law, for example. In the literature, there is an important scheme that is described by Berthelemy and al., which describes social acceptance as a three-dimensional assessment. So the first part is the community acceptance. So the stakeholders concerned by a local project, basically. Then you have the social political acceptance. So it's about policy making, and most of the time it's broader. And then the last part is market acceptance. So the adoption and diffusion of technologies in the market. This part is an older, it's an older field in social science, but actually it was not that much applied to energy technology, and there is not that much articles about it. It's more about technologies in general or other technologies. So concerning the modeling approach, actually I'm working with TIAMEVER, which is the French version of the Times Integrated Assessment Model. So it's an optimization model which uses linear programming. And the objective is to minimize the total discounted cost of the system, which is described here with net present value, the calculation of the net present value. So this model is a bottom-up model. So that means that we describe first the technical economic system, like with this reference energy system. So basically we describe the source and how they are transformed and how they are used. It's a demand-driven model. That means that the model has to reach the demand at all time. So I'm working, it's a long-term model. So I'm working on space of time from 2010 to 2100. And it's a multi-regional model. So we have 15 regions in the whole world, and we have 6 sectors. And we have a lot of data, which will be important in the rest of the presentation. So I ran some first scenarios. The first one I ran was so a global scenario that has this constraint of not going above the 1.5 degree increase in mean global temperature. So if you have a look at it, the main important things to note that first, so the electricity, in this graph you have the installed electrical capacity installed from 2010 to 2100, and you can see that in red the coal is really disappearing, or most disappearing. That the other energies are rather stable actually, but from the solar power in blue, gray, light blue, and which is really having a huge jump in 2050 and then 2060. Also we have an increase, less notable, but still there in wind power, and also at the end of the time some carbon capture electricity. If we focus more to Western Europe, as I did, you can see that this gap in the installed capacity of solar power is really even bigger in Western Europe. For example, between 2050 and 2060, we have like 600 gigawatt installed within 10 years. And so when I first ran this scenario, I thought that maybe it was too much to think that in Western Europe we would add 600 gigawatt within 10 years. So the first thing I did was to see what would happen if I said, okay, we will have 600 gigawatt within 10, but maybe within 50 years, so between 2050 and 2100, and then I put a constraint on it. And you can see in this graph, so that on the left you have the original reference graph of Western Europe, and then you have this threshold, this maximum increase in by 10 years on the right. And what you can see is that, of course, the model is working because the gap is still there, but it's very limited compared to the previous one. And the other important thing is that we have less capacity installed. So it's also so in 2060, but also at the end of the time horizons and in 2100. And that this is the main change between the two things. So we can really think that integrating some kind of social acceptance can have a huge impact on our scenarios. And but obviously these first scenarios I did was not enough because it was not integrated social acceptance with like scientific evidence, and the work I really wanted to do was to integrate some real indicators into my model to have a bigger model or a more realistic model. And so when we look into the literature on social acceptance of energy, we can see that there are some parameters that influence social acceptance, which are mainly regarding energy, economy, the territory where the project is taking place, and also some elements in democracy. So, for example, the transparency of the project, the fairness of the distribution of projects, and so on. And so I had a look at the Sustainable Development Goals, and it appears that all these parameters are reflected in this development goals. So I thought it could be interesting to integrate these goals into my models. And so if you have a look at the Sustainable Development Goals, actually we have like 17 goals. Some are really related to energy transition. For example, the goal 2, 7, and 13, and some other are less relevant concerning, but still some are relevant. These are the one in orange, and then some other are somehow not relevant at all. So we already have a difficulty to choose the good goals we want to integrate into our models. This is what I did. I selected some SDG indicators. So within these 70 goals, we have like 169 targets, and then we have more than 200 indicators associated. So that was really important to choose because the model is already big, so I couldn't afford to put 200 more indicators in my model. So what I did is I did some principal component analysis. So by zone of my model, for instance, I will show the result for Western Europe for a fixed year, for example, the year 2010, which is the beginning of my model, or the year 2015. And so what is a principal component analysis? Basically is you change the base of the data to have an orthonormal base with the first vectors being the most explanatory vectors. So you can get some information about correlation between your indicators. And then with you can do a correlation circle that projects the data in a 2D graph. And the axes are the two first most explanatory vectors. So if I do that with Western Europe, so with F1 being the first explanatory vector and F2 the second, I can see that I don't have huge clusters of data. So it's if the goal is to reduce the number of indicators, then I have a problem because I can't get a cluster of them. And if I zoom in, it's difficult. And especially that when I try to run it for different years, here it's year 2015, it changes. And for the other regions, it changes. So it's really difficult to get some some to lessen the number of indicators. So this is where I am today. So I saw that integrating social acceptance has an impact on the scenarios, and I need to find the appropriate sets of indicators. And I worked with SDGs, but it is difficult because there is a huge amount of data, and the PCA did not give clear results. So there is it's still an ongoing work, and I will have more work to do to find maybe the good way to integrate indicators, or to find indicators into energy modeling. So thank you for your invitation, and I will be happy to answer your questions if you have some.
Thank you very much, Mathilde, for your presentation. Does anyone want to start with a question? All right, I'll start then. I'm just not sure clearly understood. So there were jumps in your simulations from 2010 to 2100. Especially in 2060, you had a huge jump in wind investment. How did you exactly explain that? Is it that you had a change in your parameters, a change in the costs, or some threshold effect?
Actually, the model tends to invest the later he can. So that's why most of the time we have like investment that come very late. And I think this is one of the explanations we thought we had this huge gap in between 2050 and 2060 for the solar power.
All right, thanks. I'm not exactly familiar with the TAMS model. So what kind of reference scenarios did you take to assess what would be the future emissions of your mix? Did you take the present consumption patterns and then measured what would be the emissions with a given mix? How did you do exactly?
So actually, every technology is associated with an emission, and then the model calculates. If we have several ways to do that, but most of the time it calculates CO2 ppm, and then it's translated into temperature change. And so basically, I have nothing to calculate because I already have a complete model that associates carbon emissions to my technologies.
Okay, all right. Well, I have a few more questions, but maybe if anyone wants to have a question first. Right. I was wondering, so you talked about the NIMBY effect in your introduction. I've read that in Denmark, for instance, that kind of phenomenon was limited because people were more involved into the local decision process when it comes to investing in wind turbines, for instance. Is it something that you could take into account in your model, the level of democratization and the access and investment in renewables?
So we in the literature in social acceptance, we know that the process, for example, that when building the energy project is important. Like you have to get some, people have to trust the people that propose the project. There is a huge need for transparency, for fairness also in the distribution of the benefits, for example. But as this is very local and I have a very global model, then it is more difficult, and also the difficulty is to put some figures on it, to assess at what moment the people would oppose or not a project, and there is no clear model of that. And this is also the difficulty of integrating that, because qualitative view, we have some clear views on what affects or not social acceptance, but when it comes to putting data in the model, then it is more complex.
Okay, thank you. All right, we still have some time, so if you have some questions, don't hesitate. Okay, I think we are done. So thank you very much, Mathilde. Thank you to all the speakers. All
Thanks,
of those who
Pierre.
are still here. Thank you. Thank you also for attending the session. So before leaving, just don't forget to upload your presentations on your dashboard directly on the website. And well, once again, thank you very much for attending, and have a good evening.
Thank you.
Thank you.
Thank you.
Thank you. Bye-bye.